So, welcome to part three. This is where I just give my view on my expectations looking at the macro picture. So, geopolitics is just really sort of at the forefront at the moment. Is overshadowing, overpowering everything else. And you know the world seems a very unhappy place at the moment. There seems to be even more and more tension. And of course, you know that could trigger other nations. So it's something just to be cautious about. And you know, obviously, it's not good. So the attack on Israel has really started something that you know now may be hard to stop. Obviously, Hamas was the trigger, which opened the door for other factions in various bordering countries to join in. Now, most of the nations obviously are rallying around to support Israel, and the US and UK have sent ships out there and other stuff to support them. Many heads of state have been visiting the area, some of them to show support for Israel, others to try and sort of de-escalate the situation and prevent it from really becoming a full-blown major conflict in the area. Because if that happens, that is really going to impact supply. But, you know, Israel have been very controlled, really, in the fact that they haven't really launched that offensive. You know, they've been doing sort of little sorties where they've been going in and doing stuff, but they haven't launched it. You know, they've got over 300,000 soldiers just on the border waiting to go in. So obviously there's things going on in the background politically there to possibly either prevent that or make it a controlled response rather than an ultra aggressive. But that's just, what can you do? All you can do is just wait and see. And of course, that has taken some of the shine away from Ukraine. And, you know, that must be a concern for them, I would guess, because with this new conflict, it even means that, you know, countries are having to split their resources to help these countries out. Or maybe even instead of supporting Ukraine, move more towards Israel. It depends on the nation. So, you know, there's a bit of a mixture going on there. And of course, you know, any countries that are sort of really do a lot of business with the Middle East are going to be wary about how much support that they actually give to Israel openly, in case it damages their business with those particular countries. Of course it shouldn't, but there are certain countries and certain heads of state, which I'm not really going to name, but one or two certainly come to mind, where that does seem to be the case. But you know, this new conflict rather, you know, it's just a matter of control, isn't it? It's just a matter of, you know, whether countries can prevent themselves from getting involved any more than they need to. You know, it probably plays a little bit into Putin's hand with, you know, taking a little bit of the limelight away from Russia and the actions that they're doing. But of course, at the end of the day, you know, we want the world to be a happy place. But this has led to sort of the geopolitical situation overpowering the economic situation, and you know, any data that was coming out in the markets. You know, even China sort of seeming to have managed to turn the corner, just wasn't enough to save the stock market. You know, that sort of progressively moved lower day after day all week. It was making lower highs each day. So again, that's something to sort of be mindful of. And it does come back to the point I've been making over the last few weeks or couple of months, that you know, diversification, you know, putting more into the fixed income where you've got that guaranteed return for years to come. And of course, you know, to me, they're probably performing better than what the stock market is. And you know, when you look, the stock market has been coming off, and you've had those head and shoulders forming, and you know, you're in that situation where the stock market could become more vulnerable. Just remember, this is only my view. I'm not sort of saying sell your stocks or anything. That has to be your decision, or at least think about how you can hedge those. And you know, there are so many ways to do that. So you know, it sort of gave oil a bit of a mixed week, really. It sort of ended around $88. You know, on one side, concern about what's going to happen on the Middle East could cut supply, and then the US have lifted a lot of the sanctions against Venezuela, which allows them to now export oil, gold more freely. And you know, even that, you know, gold was probably the winner last week. It sort of rallied over $2,000 and finished just below. So that was a big move up. The dollar seemed a little bit range bound. It didn't sort of take off, and even when treasuries sort of had a volatile move, and you know, the 10-year move towards that sort of big focused point of 5%, the dollar never really went with it. Now, you know, Powell's sort of practically taking a November hike off the table now, but that does leave the door open for December, of course, and December is one of those traditional times of year when, you know, things, a change of policy usually comes in December. But you know, whether they'll need to do another rate increase or not, I don't know. Yeah, as I keep saying, they still got the best economy in my eyes. It's really strong, and you're just seeing that even in all the data that's coming out. Now, other central bankers were not so sure. You know, with the focus on inflation, it's still stubborn, and it's just not dropping as fast as they hoped. But of course, you know, with energy prices creeping up again and holding stronger, you're not going to see that come down. You know, it was coming down quite nicely, but you know, all this geopolitical situations, they do have the sort of potential to reduce supply chains at some stage, and that has to remain a concern. So unfortunately, with all the conflicts that we are having, you know, prices could actually start to rise again, and of course that's not going to be good news for the central banks, or possibly for us, because that means that interest rates may have to have that extra increase either by the end of this year or early next year. But you know, that emphasis about higher for longer is something you've really sort of got to get used to, I think, going at least into the middle of next year, possibly even further. But you know, again, just remember, this is only my view, but you know, headline inflation, core inflation, core inflation is going to be impacted a little bit less, but the headline inflation, I think, could just either stay steady or even just pick up slightly, just because of what's going on with energy. Corporate earnings have been a little bit mixed, as you would expect, and when you look in the US, mortgage rates are nearly at 8%. So China, they injected the most short-term cash on record to keep funding costs low, to try and support their economy, and you know, perhaps that's starting to work a little bit. It seems as though it's bottoming out. You know, the data that came out has been reasonable for sure. Now, talks are ongoing between the US and the EU for a trade deal on steel. But there isn't an agreement there. They're hoping to get one by the end of the year, but you know, I don't know whether they're going to get that or not. But you know, the EU are trying to get as much of an agreement done while Biden's in power, because obviously next November, just over a year, is the US elections again, and they, you know, what they fear is Trump getting back into power. Of course, that's if he's not locked up. And you know, will Biden get back in? I don't know. You know, again, Biden sort of Bidenomics and, oh, I've done so well for the country, look how strong it is and all that. But has he really done that much? And what he's done is, has it been really good? Because, you know, he can say, okay, I put all this stimulus in, I've saved the economy and all that. Yeah, but then they're partially responsible for the inflation that came afterwards. Of course, a lot of that inflation came from supply chain shortages. So when we look at the data, you know, that sort of the US GDP that was released this week is it's likely to be close to 4%. So again, that's higher than expectations earlier in the year, but it just goes to continue to prove that I would say probably the majority of analysts have been wrong this year, because it leaves them on course for a soft landing or potentially even no landing. You know, I've been sort of talking about this, as you know, if you've been following these week on week, month on month, and definitely in all my newsletters, saying about how strong and resilient the US economy is, and that's going to carry on. Politics is such a sort of a challenge in the US, I would say, at the moment. That's probably their downfall. You know, they're still struggling to agree a new speaker, and without that new speaker in place, it's very difficult for the government to actually get any policies passed, unless, of course, Biden does some of those executive orders. Higher yields are giving central banks possibly the chance to pause the rate hikes, because, you know, with those higher yields already priced in, it's perhaps taken away a little bit of the need for them to do anything. Now, so as I've mentioned in recent weeks, those bonds have become more attractive to me than stocks. You know, okay, we know that rates are near or at the peak, but, you know, the bonds actually offer that fixed return for the duration, whereas stocks are, you know, they're just starting to look a bit weaker, and they've been falling. I mean, look at last week, they just dropped day after day. So, you know, if you're holding a stock portfolio, as I mentioned, you know, and if you haven't hedged, consider how you could do that. And that can be done either using, you know, the indices, or maybe options. And, you know, we do courses on all this stuff to help you if you need it. And, you know, if you're going to do some hedging, make sure that you select whatever's going to be closest to the makeup of your portfolio. Now, when we look at sort of potential recessions and all that, I mean, you know, the number one, number two countries, they're still putting in good GDP growth for 2023. Europe, not so great, but, you know, it's not as bad as it could be, I suppose. And again, you know, as we're leading or coming into winter, each week I say, oh, the weather's doing this, the weather's doing that, and then it changes. I mean, today, you know, it's beautiful and sunny in the UK, but, you know, we're not in winter yet, and that winter is going to be sort of key. Although, you know, I think last year it was much more important because of the gas supplies were low, because obviously the Europe definitely had still that strong reliance on Russia gas, which wasn't coming through. Obviously, since then they've as much as possible replaced Russia for their gas supplies, and you know, that's important because, you know, storage is very high, so it would have to be probably a real severe winter to sort of drain them down. Yeah, so maybe that may be enough to stop Europe going into any form of a deep recession, for sure. Whether it's going to stop them going into a shallow one, I really don't know at the moment. And again, you know, we've got to look at the ECB's meeting this week to maybe have a little bit more of an idea of what is going to go on there, and if they're going to hold rates, which may be enough to stop a recession. But again, it's still high rates, high inflation. Inflation's coming down, but not fast enough. And of course, you know, as I keep saying, the closer it gets to that 2% level, which it's not close to at the moment, the harder it's going to get to achieve it. And then, you know, as again, as I've been saying for months and months and months, that when finally they get it down to that 2% level, I believe they're going to want to leave that there for 3, maybe even 6 months before they even consider doing anything with interest rates, to make sure it's going to stay there. The last thing they want to do is sort of change things around, cut rates, and then see inflation pop again. They're not going to want that to happen. This inflation has really scared central banks, and they're going to do their best to make sure that it doesn't come back. So, Biden lifting sanctions against Venezuela, it was one of the things that I said that he needed to consider if he wanted to sort of have any chance of getting oil prices down. It was either them or Iran. I mean, talks with Iran seemed to be going fairly good until, of course, the attack on Israel, which has put a lot more tension into the whole region again. So, just keep an eye on what's going on with that for next week, because that is going to be sort of really important. Listen to the news as it comes out. If you're not getting sort of live news, reach out to us, because we have what we call the squawk. So it's an audio news service. We can focus on the markets. We don't miss any of the price action. All we do is just have our headset on or put it through speakers, and we can hear all the news as it comes out, and we can react in real time. And that is a great opportunity. So if that's something you haven't got and it's something that you would like, then reach out, and I'll give you the details for the guys. They're really, really good. And you get reports, and there's a lot more to it as well. So it's not just the actual audio, just listening to the notes, but that is the most important, because you're getting that real time. Okay, so now we're going to move on to part 4, where we look at sort of the charts of what's been going on with a selection of different asset classes. So we offer newsletters, we offer workshops, 1-week courses, our comprehensive masterclass that's really going to help you. Apart from gaining all that fundamental knowledge, you get to spend 20 trading sessions with me, practical sessions. So that's I'm not saying I'm going to turn you into a massive trader in 20 sessions, but getting that sort of feedback from me, that insight from me, is valuable. Now, other things that we offer are trader mentoring. We consult to companies on FX and commodity exposure. Of course, we provide a massive educational content to individuals, exchanges and brokers. If you feel underfunded, why not give the trading challenge a go, and see if you can get that funded account. Maybe you're underfunded, maybe you don't want to risk your capital, which is quite understandable. And of course, one of our courses now includes a free attempt at the trading challenge. If you would like to find out more about anything, then contact us at info@symaxfintech.com, or directly to me at chris.tubby@symax-int.com. Okay, so now we're going to go into the technical analysis section. So I hope you join us for part 4.